Hey, and today we are up $35,753, mostly because the S&P 500 has hit a record, and we might pass 4,000 in the S&P 500, which has never happened before. So I wanted to make sure that we made this video on should you be buying at all-time highs in the stock market? Because things are higher than ever, and the saying is buy low, sell high. So should you start selling? Should you wait? Should you keep your money in cash? I'm going to be talking about what I'm going to be doing with a few $100,000 in cash that I have that I'm going to be deploying into the market. I'm going to be showing you what I'm going to buy. I'm actually going to buy something in this video, but we're going to be talking about, is it more dangerous historically to be buying at the highs? Should you wait? What does history tell us? What should you buy if you do want to get into it? And what I'm actually going to be doing each week, and I'm going to be showing you exactly what I'm buying. The goal of this channel is to give you unfiltered, transparent advice, and so I have no reason to hold anything back, and that's why I am anonymous. I'm not going to tell you to get free stocks with Webull or to join my Patreon or to buy my course. All I want you to do is click like on that like button so we can get this video and other important videos out to more people, because I think it's valuable. And it's the same strategies, the same mindset that's helped me create a $3.3 million portfolio. So here is the S&P 500 right now, 3,990 as of this recording. It's live, the market's still happening. And what we got here is, check this out. So here's the day range. So this is the range of the price of the day, 39.66 to 39.94. Here's the year range. It's crazy, 2,447 to 3,994. See that? That means that we are at the all-time high. So should you buy? Should you wait? This is the S&P 500. So this is the top 500 companies in the US stock market. However, the overall market is pretty similar. If we look at the NASDAQ, right here, we are very close to all-time highs. We had all-time highs last month, but I mean, we are very close. Everything seems to be inflated. You look at the housing market, it is crazy how prices have inflated across so many asset classes. Bitcoin, stocks, real estate, NFTs, Pokemon cards. It's crazy. It seems like everything has been just going to the moon. So what does that tell you? Are we about to see a major crash? Whenever I decide if something's a good idea or if I just want more perspective, what I try to do is I try to zoom out as far as I can and see what has happened historically. So if we do that with the market right here, we have the New York Stock Exchange Composite from 1965 to the present, and we can see some hills, some valleys, some recovery, and we can see the years. Now what you'll see is things can recover within 3 years, or over here, it's taken 8 years to recover. Let's look at the dot-com bubble right here in the year 2000. It's taken 2, 3, 4, 5 years, 6 years to recover. How about here? If you bought at the absolute worst time in 2008, we have 1, 2, 3, 4, 5, 6 years it has recovered. So a really important factor is how long are you going to invest for? So here is a simulation that was done between 1926 and 2019, checking how, if you invested, what are the chances of you losing money? So if you only invested for 1 month, then on average you would have made money and had positive returns 62% of the time during that time span. You would have lost money 38%. What you're going to start seeing here is that the longer you hold, the lower the chance of you losing money at all. 1 year, your chance goes down to 25%, 5 years, 11%, 10 years, 5%, and 15 years, there's only a 0.2% chance you would have lost money. So you would have had to buy at the absolute worst time. It's a 0.2% chance. That means you have a 99.8% chance of not losing money and there not being that risk. Now, it doesn't mean that the future is going to look like the past, but this is a pretty big date range, right? This is 90 years. So a lot has happened during this time. There have been massive diseases, there's been world wars, there have been trade wars, there's been a lot of things going on, terrorist attacks, a lot of things have been factored in for this and this data. The next graph that I want you to look at is the returns of the S&P 500 if you had a $10,000 investment somewhere between January 2001 and the end of 2020. So this is what happens if you just miss out on some of the best days in the market, because the best days in the market can dramatically affect your portfolio. The ways you can miss out are if you're not investing and you're holding money, hoping for things to drop, and you're just messing up by not being in the game. If you fully invested, you would have a $42,000 portfolio. That's a 7.47% return. If you missed just the 10 best days of the stock market, right? You got out and then the next day was one of the best days, you would be at 19,347. So still good, you doubled your money, but you're less than half where you would have been if you just stayed invested. You didn't try to time the market. If you missed the best 20 days, it goes down to 11,000, yada, yada. If you missed the best 2 months, you'd be down $2,441 as your total portfolio. So you would have lost money. Now, this is very cherry picking because it's saying, hey, you missed the 10 best days. It doesn't say, hey, you missed the 10 worst days. But the idea is that staying fully vested is so much easier. And with the chances being so low of losing money over time, this is the way that you should approach things. JP Morgan actually had an article and they did some data on that investing on days where the S&P 500 closed at a new all-time high can actually produce better returns than investing on a day where the market did not set a new record. So here's some data on that from JP Morgan. The 1 year cumulative gain, if you invested on any day, would average 11.7. If you invested on an all-time high day, it would be 14.6. 3 years, you can see the difference there, and 5 years. So investing at all-time highs during at least this time period actually created better results than if you did not. So what should you do? Well, it's important to know when you want to start taking this money out. The longer you're going to keep it in, the lower chance it's going to have to lose value. And I can't tell you what to do because I'm not an advisor, but this is educational purposes only. I can show you what I'm doing with my $3.3 million portfolio. I have 200K or so in cash. I'm adding into the cash into this account so I can put money into the market regularly through what's called dollar cost averaging. Dollar cost averaging is the idea that you are putting a certain amount of money into the market in regular intervals. So what I do is every week I put in around 20K into the market no matter what. So if it goes down, great. If it goes up, gotta still put money in. Sometimes it's painful at all these all-time highs to keep putting money in, but I actually do this exercise to make myself feel better about doing this on an ongoing basis. So what am I going to buy? Let's go ahead and make a purchase right now. So what am I going to buy today? Well, a lot of you guys know this. It's VOO. It's my favorite index fund. If you want to learn more about index fund investing, make sure to watch a video on the 3 different index funds you need for a diversified portfolio on my channel. This essentially is holding the 500 biggest companies in the USA that make up the S&P 500, and it moves with the market. We're going to go ahead here, VOO, we're going to click buy, we're going to choose the quantity. So with dollar cost averaging, I'm not choosing the exact same quantity every time. It's not like I'm buying 100 shares. Instead, I'm buying a certain amount of money of that stock. So I'm going to do this so it averages out to around $20,000. So I'm going to go here, I'm going to click market order because this is what's going to calculate the value. I could do other stuff here if I wanted to. I could do limit, I could do a stop limit, but right here I'm just going to go ahead and try to get this to $20,000. So on my channel I bought 69 shares a couple videos ago, and now me buying 69 shares, well, that would be 25,000. If I want to stick with around 20,000 in the market, what I'm going to do is I'm going to try to get this to an actual number that is closer to 20,000 because I'm dollar cost averaging the amount. I'm not dollar cost averaging in terms of the amount of shares. So there we go, 55 shares. Let's go here. Right now, we have 3,639 shares. You see this 0.4144? What that is it's because what I always do is I have this set up, reinvest dividends. So it does pay a dividend equal to the average, equal to the dividends of the stocks that it carries. So that is how it actually pays a dividend as an ETF, an exchange traded fund, and as an index fund. So I keep this set, and that's why I'm just constantly adding shares, because anytime I get a dividend, it just repurchases VOO. Let's go ahead and let's click review order and buy it. All right, there we go. I bought VOO. If you look at my history, just so you see, I might buy Tesla if it dips, but guess what I do every week is I gotta buy VOO. I buy VOO. If there's a dip in Tesla, maybe I'll buy that. Dip in Apple, maybe I'll buy that. But what do? I buy VOO. Bought Tesla at a dip, buy VOO, Tesla, VOO, VOO. So you can see that I'm trying to consistently buy and dollar cost average into the market. So hopefully this video makes you feel a little bit better about investing at the highs. It's really painful for me to click buy when it's at all-time highs. I feel much better emotionally buying at lows, which is actually contrary to a lot of people's emotions, right? When things are going great and the market's doing good, people are like, yeah, I can buy and it's gonna keep going. I've now kind of trained myself to think the opposite, so much so that I have to convince myself to keep buying as things move up. So hopefully this has helped. Leave a comment. I would love to know what you think. If you're buying, if you're waiting, what's going on in your head? Are you dollar cost averaging? What's your dollar cost average schedule? Try to stay consistent. That's the key. The more strategy you use, the more thinking, hey, you know what? I'm going to put a little less because the market's hit higher this week. I'm going to put a little more if the market's gone down a little bit. The more strategy you use, just realize that's timing the market, which is not possible for you to do. So no one can consistently time the market, even the pros with the crazy algorithms, the billions in investments, everyone that maybe even has insider information, like they're still not doing a good job at timing the market, so you shouldn't either. That's it. I'll leave you with one thing that might make you feel a little bit better here. 3 doomsday experts foresee economic devastation ahead. Don't worry, this was in 2012, and we've seen the most amazing bull run since then. So all those guys that said to escape in 2012, well, didn't work out super well for them. That was right around here. So that's it for this video. Thanks for watching, and I'll talk to you soon.